All right, good evening, everybody. Welcome to class number 3, June 23rd, 2020, live and in color from Claremont, California, Business Finance Central. A rather warm evening in Claremont, California. I hope everybody is well and you have had a nice Father's Day weekend with the family. And we begin this week with our topic on our agenda, past, present, and future in finance. We're talking about chapter 5 in your text, the time value of money. One of the most important tools and concepts of finance is to know how to calculate the present value and the future value of money, either in one installment or a series of cash flows over a period of time. A very important concept, and we'll be going over multiple problems tonight to practice that. You also have this week your first assignment, which is 10% of your course grade. That assignment will be posted in the 7 o'clock hour during our break in our Blackboard site under assignments file folder. And we'll talk more about that later. Assignment number 1 is due next Monday evening at 9 p.m., June 29th. And you will post that to Blackboard by that time. The assignment is involving chapters 1 through 4. So that's our task for this week, is to learn the concept of time value of money, practice it a little bit, and then have your first assignment for graded work outside the classroom to post to Blackboard in about 6 days. One moment, a couple of our students are having difficulties signing on, so I'm helping them. Okay. Okay, let's begin. Last week, at the end of the class, we talked about this financial statement of this company, taking a look at the financial statement in balance sheet, in income statement, and in the cash flow statement, and how we determined these different financial statements, which were spun off our accounting class about what is the result of our financial accounting transactions and what they looked at. One of the things that I wanted you to do is, in regards to chapter 4, is take a look at the financial or statement analysis of this company. And I had a sheet like this that was blank. And I encouraged you to try to follow that, not for a grade, but try to complete it. And because you're going to be doing these things this next assignment, in this current assignment, this week, assignment 1, where you're going to be selecting one of the companies in your portfolio. And you're going to be doing some research on their financials of that portfolio, from the portfolio. So let's say you have a group of 4 stocks in your portfolio and you pick McDonald's. So you'll need to go into the internet and do some research and locate McDonald's financial statements and also determine these ratios for the last 2 fiscal years of your company. So understanding these and understanding how to calculate them is important. But also I'm going to show you a website in our University of Laverne library that also provides this information for you. It's part of the library databases that you have access to as a student, and I'll talk about that a little bit later this evening. If you're curious about these calculations of these financial statement analytical numbers, I refer you to page 105 of the textbook. And in 105, they give the definitions. As a matter of fact, chapter 4 gives all the definitions of those financial statement analysis and also the equations by which how to calculate them. So page 105 in your textbook is a good reference source in addition to doing this problem on your own or looking at this. If any of you are curious in Blackboard, let me bring that up. It's not it. In our Blackboard site, under week 3, that's this week, the file folder is time value of money. You'll see a week 3 in-class review. This is this spreadsheet that I'm looking at right now. You can download that spreadsheet to your desktop and follow along with me if you'd like. If not, that's where that is located for after the class. There's a template there of the financial statements that we're reviewing tonight in class as review. Also, here are the solutions to the problems I will be reviewing tonight in class, a hard copy if you so desire, but I'm also going to be reviewing those problems on a spreadsheet this evening in class. So just to remind all of you, remember every week has materials for the relevant topics per the syllabus in Blackboard. Here's the introduction video I sent you yesterday, explaining the context of the class this evening. Here's our agenda for this evening, which you saw in that introduction video, but also there's the agenda to refresh your memories. There's some videos about the time value of money definitions taken from our YouTube playlist. And there's a PowerPoint presentation and another video by the publisher of our textbook to highlight the definitions of the time value of money, plus my own little quick review of the contents of the chapter. So again, one of the great ways of preparing for a class and a lecture is a day or so or the evening before class, you go through the week numbers, the week accordingly file folder to look for information, download information, get prepared for class so you can follow along with me. Now, naturally, we have quite a large percentage of students not attending this evening for a variety of reasons. And that is the case. I will be actually providing the video of this lecture tomorrow morning, posted to the link will be in the Zoom links file folder. There's the link to last week's class. You click on that and you immediately can go to the YouTube playlist where that video is located, and I'll do the same thing for next week. So that's the procedures, that's the information, and especially now that we're getting into the assignment section of our assessments for this class, we've done the portfolio. We've talked to Professor Hassey one-on-one, talking about the class, answered any concerns, and now we're getting into the written work that is take-home. And we'll talk more about that assignment a little later. So that's the process. That's the way we do things. If I speak or go a little too fast for you, you can send me a chat to go over that by typing in a chat, or you can just turn on your microphone and say, hey, Professor H, cool it. Tell me what's going on. So you can do that, or you can just send me a chat
Michigan sucks.
if you so desire. All right. So as I said earlier, we talked about this last week where we had a financial statements of a company in week 2, and we took a look at it because this is chapters 3 and 4, financial statements and financial statements analysis, where accounting and finance meet. Accounting, naturally, a lot of you have just taken accounting or have taken accounting. Accounting is the recording of the business transactions via journal entries, posting to the ledger, adjusting entries, adjusted trial balance, preparing the financial statements, and then closing the books. That's what accountants do. All right, that's what they do. The finance people take a look at those financial statements, a historical review of what happened. What happened in 2018? What happened in 2019? And from that information given to you in these financial statements, the balance sheet, which is a statement of assets, liabilities, and equity positions at book value of the company. These are not market values, these are book values. The income statement, or as many times some companies call them, the profit and loss statement, the P&L, or the revenue statement, whatever they call it. Each company has their own little names for these things. It's a statement of revenues and expenses for a period of time, usually 1 year. Excuse my years are off here. That should be 2018 and 2019. Professor Hasse, you need to get prepared for class, for Pete's sake. All right. And then also off of that comes the cash flow statement, which shows how cash has changed in a year. Where did the cash come from? If you notice in the balance sheet, the delta of cash from 2018 to 2019 was $6,718. Where did that money come from, that $6,718? Remember, cash is the lifeblood of a company. Without it, you can't pay people. Without it, you can't develop new products or new markets. Without it, you can't keep your investors happy by paying off your debts and sending dividends to your shareholders. Without cash, you can't pay your employees and keep them committed and loyal to your institution. You gotta have cash, euros, pesos, dineros, whatever. So cash is an important financial statement, cash flow statement for financial people. We are now financial people. And here's the cash flow statement showing where that $6,718 came for this company in 2019. And cash flow statements are designated by 3 areas: cash flow from operations, cash flow from financing, cash flow from investing. The combination of all 3 needs to total your delta of cash for the current year, in this case 2018 and 19. We started out with $7,282 at the beginning of the year. We ended up with $14,000 of cash. The net change is $6,718. Where did that cash come from? Well, it's the joining together of the financial statements, figuring out the deltas of the accounts, how the accounts have changed over the course of the year, and putting those deltas in the appropriate category of the cash flow statement. Now, here's an important thing that many of you are going to bring a smile to your face or reduce the stress. I'm not going to ask you to put together a cash flow statement, but I will ask you, what does it tell you? What does it mean? It determines, it gives us the total change in cash and where it came and went during the course of the year. In operations, it's net income, the profits of the company, cash coming in. Cash coming in, depreciation, $120,000. Wait a minute, Mr. Hasse. When I had you in accounting 203, depreciation was an expense of the business. but it's a non-cash expense. You're not writing a check to Mr. or Mrs. Depreciation. You're expensing something, but you're not spending any money, any cash anyways. So you add that back in as cash flow in operations. Accounts receivable and inventory are operating assets. Notice on the balance sheet, those two numbers went up dramatically from 2018 to 19. Receivables increased, inventories increased. When assets increase, that's negative cash. In other words, we're not collecting our receivables and we're not selling our inventory. Negative cash. Accounts payable and accruals are operating liabilities. They're the direct opposite of assets. If assets go up, negative cash. If liabilities go up, you're borrowing money or saving on cash. That's cash coming into the business. Assets increasing, negative cash. Liabilities increasing, positive cash flow. You don't have to spend money because eventually you're going to have to spend money in another period to pay those bills. But as of the end of December, liabilities increase, that's positive cash flow. These are the definitions of operating cash flow: net income, depreciation, operating assets, and operating liabilities. In this case of this company, ouch, negative $170,536. The financing accounts of a company: anything that has to do with interest-bearing long-term debt, common stock, and the payment of dividends. Notice in the balance sheet, our long-term liabilities decreased. During the course of 2018 and 19, they went down $420,000 and $500,000. That means we paid off some of our debt. Notice negative cash flow, the deduction or the reduction of liabilities right there. At the same time, the company issued 150,000 shares of stock and received $1.22 million as the increase in the common stock balance of the company. They issued more stock. Thus, we have $1.22 million coming in as positive cash flow for the business. They issued stock and received cash. They paid off some debt and dispersed cash. And then finally, they paid $55,000 in dividends, 22 cents a share times 250,000 shares of stock. That's $55,000. There it is right there, 250,000 shares of stock at the end of 2019, and they paid 22 cents a share. That's $55,000. That's negative cash going out to your shareholders. The combination of paying off, in this case, debt, the issuing of more stock, and the paying of dividends, this company had a positive cash flow of $245,936 from financing. And then in investing, where did they invest into third parties? Well, they had a short-term investment delta of $51,632. That's probably putting money into a money market account, something like that. And at the same time, they increased their fixed assets by $17,050. They bought some more equipment. So notice, the purchase of an asset, short-term investments, negative cash, $51,632. The purchase of additional fixed assets, $17,050. That's $68,682 of cash going out to the purchase of short-term investments and fixed assets. The combination of negative cash from operations, positive cash from financing and negative cash from investing. Golly Gomer, $6,718. And that matches the delta in cash. You know somebody did the books right. This is not Enron. Everything matches. Everything's cool. This is not Trump's Incorporated Real Estate Ventures. Everything balanced. No funny business going on here. And if there was, we wouldn't see it anyways if it was Trump. They never show him anyways. That's my only single political commentary for this evening. So if you're a Trump fan, deal with it. And we move on. Okay. Now I just alienated the Republicans in the audience, but a little alienation is good. Remember, I'm the professor. I'm in power. I can say anything I want to a point. That's about as far as I can go.
Yeah. We pay for this class.
Excuse me?
I said, I paid for this class. So I don't appreciate that.
You don't appreciate the political commentary?
No, I don't.
I apologize then. Can I say something good about Teddy Roosevelt? No.
I'll watch your class later. Thank you.
Oh, I'm sorry. Okay, so back to this. So the cash flow statement is telling us where our cash came from. And as finance people, that's very important because we're trying to maximize the value of the company. And then we're also going to be determining what to do with this information going forward. The next part of the analysis last week was we looked at chapter 4, which was statement analysis. In the statement analysis, we took a look at what do these certain ratios, certain liquidity, debt management, profitability, efficiency ratios tell us about our company's performance. And we can compare that to prior years. We can compare it to our competitors. And we can compare that to the industry that we're in. I can't tell you what these are real financial numbers, so I can't tell you this company is a local firm here in Southern California, so I can't disclose the name of the company. But this represents the industry that they're in Southern California. So these are some ratios that are very important for you to note coming out of page 105 of the textbook. The current ratio, it's called the liquidity ratio. It's the relationship of current assets to current liabilities. It's called, do you have enough short-term funds to meet the short-term obligations of the company? Current ratio. Current assets divided by current liabilities. The debt ratio. The relationship of debt to the assets of the company. Total debt divided by total assets. Notice in 2018, this company had almost 81% of their assets funded by borrowed money. So what did they do in 2019? They issued some stock and got some cash. And what did they do with that cash? They paid off about $920,000 of long-term debt. Thus, the relationship of debt to assets at the end of 2019 is significantly better because they paid down on that debt with the cash they received from the selling of the stock, 44%. So their debt management got better, but they broke a cardinal rule in the management of a company. They used the most expensive capital, stock, to pay off existing debt. When you expend or if you release or sell stock in the market, that's the most expensive way of raising money. You have investment banker fees, you have accountant fees, you have lawyer fees, and you also have the expected return demands of the stockholders who are giving you their money. They want a return on their investment fairly quickly. That's expensive. If you use that money to pay off existing debt and not creating new assets and new growth, that's gonna hurt down the road. So yes and no as far as debt management. Usually you use your profits and the generation of cash flow from operations to help you pay off your debt. In this case, this company used common stock. So then we get into the profitability analysis of the company. Profit margin on sales. Net income divided by the total sales of the company. Net income divided by total sales. If you notice, last year they lost money, so they had a negative profit margin. They lost $95,000. They made a nice profit of $253,584 in 2019. Thus, their profit margin increased to a little bit over 3.5%. For every dollar of sales, they made the profit margin. Naturally, you want that to be fairly high. You want to have a good profit margin. But some industries can't have high profit margins. Retail industries, for example. Walmart, Costco, Target makes only about 2, 3, 4% on every sale. How do they generate good returns? They keep selling it over and over again. That's where you make your profits, your large profits. You keep selling those profits for those thin margins, but keep doing it over and over and over again. So this company's profit margin is fairly low, especially in consideration of their industry, which is 5%. The next number is very important for us later on in this class when we get into chapters 8, 9, and those capital budgeting chapters, is the relationship of net income to total assets. What kind of revenue or what kind of generation of return are the assets generating for us? And here the net income is a little bit different. If you notice on page 105 in return on assets under profitability measures, it's after tax operating income divided by the total assets. It's not net income, it's after tax operating income. And I take that after tax operating income and divide it into my assets. Well, if you can see this file, or you can look at it later, you'll note the formula that I have for after-tax operating profit. And what I did is I went to the income statement. Here's my after-tax operating profit for 2019, $502,640. It's earnings before interest and taxes. And then what I did is I took the tax out of that. I did not include interest. And that's the number I used in my financial analysis. I took the operating cash profit and minus the taxes. And I got that number and then divided it into the asset value. Notice in year 2018, because they lost money, I added that tax back in because they got a tax refund. They lost money in 2018, so they got a tax refund. So this is the relationship of operating profits, not including interest, to asset value. This is the number we look at when we want to see if we're returning on a capital investment. We'll talk more about that in later chapters, but the return on assets, it's calculated a little bit differently. It's not net income, it's operating profit, which is earnings before interest and taxes, less the tax, and that is divided into total assets. And you can see that in chapter 4. I'm going to skip on down to earnings per share, which is another way of displaying income, net income for a company. It's the net income in relationship to the number of shares of stock outstanding. So relationship of earnings per share is the relation of outstanding shares of stock to net income. Well, in 2019, they had $253,584 of net income. That divided by 250,000 gives us $1.01 earnings per share. That's another way of saying, instead of saying, hey, everybody, we made $253,584 last year, we made $1.01 a share. That's compared to a loss of 95 cents a share in 2018, where they had a loss of $95,000. That in relationship to the outstanding shares of stock in 2018, which was 100,000 shares of stock, you get negative 0.95. Earnings per share is a very important number used in finance. Notice they're quite a bit lower than the industry average to their competitors of earnings per share. And that leads us to an analysis of market value. And that is the price earnings ratio. This is used by a lot of stockbrokers and stock analysts to talk about whether the stock is undervalued or overvalued in the market. It's the relationship of the stock price to the earnings per share. So if we saw the financial statements for this company, the stock price was $12.17 at the end of 2019. We just determined that the earnings per share was $1.01. What is the relationship of the stock price, $12.17, divided by the earnings per share? Well, roughly it's about 12 times greater. In the case of 2018, it was negative because we lost money. That's not very good. But what stockbrokers and stock analysts do is the lower the PE ratio, the more attractive that stock is to purchase. It's considered undervalued. The stock price has room to grow because it's so close to the earnings per share number. Whereas you look at the price earnings ratio of other companies with a PE ratio of 80, 70, 60, that is very high. In the terms of stock analysts, that can be considered the stock is overvalued. The market thinks it's worth more than it actually is producing an income, profit. So they consider that overvalued. Now, that's one side of the analysis. It's called a technical analysis. But if you look at companies like Tesla and Amazon, their PE ratios are historically very high, 40, 50, 60, 70. And the reason for that is because the market loves those companies. So they bid up the price even more. And those companies, in the case of Amazon, produce results, which is a good thing. Tesla, it's overvalued because investors think eventually it's going to be very valuable as Tesla begins to develop their products and make profits. So it's a technical type of issue, but PE ratio is the relationship of the stock price to the earnings per share. And then finally, we close out these key financial analysis from chapter 4 by looking at efficiency indicators. One is the average collection period. How quickly do we collect our receivables? Well, the average collection period takes the beginning accounts receivable balance, which happens to be the balance at the end of 2018. It takes the beginning accounts receivable balance and divides it by the average daily sales of the company.
Say that
So
again.
I beg your pardon?
Say that again, Professor.
It's on page 105, but at the same time, it's the average collection period is the beginning of the year, December or January 1, 2019 accounts receivable balance divided by the average daily sales. Well, if I go to the financial statements, the accounts receivable balance at the end of 2018, which is January 1, 2019, is $632,160. We started out the year with that much in receivable. Then we sold had sales of $7,035,600 in 2019. And what I do is I take that sales amount and I divide it by 360 days. Yes, the year is 365, but I just keep that a whole number. So I divide it by 360. So if I take the beginning accounts receivable balance and divide it by sales divided by 360 days in a year, I get my average daily sales. My receivable collection period for 2019, I averaged about a little bit over 32 days to collect my receivable. The industry average was about 28 and a half. Most companies have on their invoices, and you guys know this, 30 days to collect my money. They're running a little bit longer, a little bit over 32 days. And that gives you an indicator of efficiency. Maybe they need to work on their collections a little bit. And the final efficiency indicator is inventory turnover. How many times do I sell my product during the course of a year? And inventory turnover is the, as you notice on page 105, inventory turnover is the inventory balance at the start of the year, January 1, 2019, inventory balance, divided by the cost of goods sold for 2019. How much inventory I purchased during the year. So if I go to my financial statements, I see that my inventory balance at the beginning of the year was $1,287,360. And I just made a goof. What a knucklehead. Let's redo that. I did the wrong equation. Let's do that again. We take the inventory balance at the start of the year. I had it backwards. 1,287,360. 1 million.
If you hit escape, it'll let you out of it.
Thank you. Didn't know that. Thank you. So if I take 1,287,360 and divide it by my cost of goods sold for the year, my cost of goods sold for the year for 2019 was $5.8 million. Let's put that, get those in there. Ugh. 0.22. Ugh. You know, I had the right number before. Geez, I shouldn't have had that bottle of wine before class tonight. I had the right equation earlier. My eyes are playing tricks on me. Excuse me, everybody. I apologize. I had it right the first time. It's cost of goods sold, or cost of goods sold, $5.8 million divided by the ending inventory, the beginning inventory balance on the balance sheet, 1,287,360. There we go. There. Okay. Thank you, Mr. Hassey. Now come back down to planet Earth. 4.51. In other words, we turned over our inventory 4.51 times. We purchased $5.8 million of product during the year, and we started out the year with this in inventory. In other words, we turned over our inventory roughly about 4.5 times. But naturally, the higher this number, the better. That means you're selling your inventory. You're ordering more inventory, you're producing more inventory, you're selling it. Notice the industry average was 6. I'm sorry, I kind of screwed up the flow there. Inventory turnover is the cost of goods sold from the income statement divided by the beginning inventory balance at the beginning of the year to get how many times you turned over your inventory during the course of the year. For companies like Walmart, their inventory turnover is roughly around 10 or 11. Pretty high. But for this company, it's about 4.5. A little bit lower than the market. So these are indicators of financial statements that help you analyze the data. We take a look at the statements here, and then we go to a statement analysis, this is chapter 4, to pick out certain things about this information: liquidity, debt management, profitability, market value, efficiency. It tells us about the management, it tells us about the company. We can compare that to competitors, we can compare that to our past. Have we done better or gotten worse over the last period of time? These are indicators that are important to finance people to get a picture of the management and the numbers of a company. You're going to be doing this next week in assignment number 1. And you're going to pick one company from your portfolio and locate this information. Now, where do you get that information? Where, if I have a company in my portfolio and I select them, where am I going to find this stuff? Where am I going to find their financial statements? Well, you can go to a variety of resources. You can go to the internet. All right, so let's go to the internet. I can go to an outfit like Yahoo Finance. And I can type in, let's say I decided to do a Yahoo Finance. One of my companies in my portfolio is Chevron. So I can bring up Chevron. There it is right there. And we've done this to find some of our portfolio stock prices in the past, and we'll do it again, not this week though. And you can go to financials. See right here? Financials. And I can click on the financials of this company, and it will tell me the income statement, the balance sheet, plus all the details, and the cash flow statement, which you won't need to use for our assignment number 1. But you can find all this information in Yahoo Finance by the year. And you could go through and maybe calculate out your information based on knowing the formulas from page 105. All right? You can do that. You can also go to the company's website, to investor relations, and they will have that data for you as well. Bless you, Erica. At the company's website. But there's another place that you can go, which I highly encourage you to do, and that's the University of Laverne Library. So let's go there. This is the University of Laverne's library, or the website. Now, part of the fees that you all pay to come to school at Laverne go to maintaining the library. Even though you're taking this class online, you still have just as much access to the library as anybody else. So if you go to academics and click on Wilson Library, up comes the library's website. By the way, if you go to our YouTube playlist, this explanation of how to do this is in a video in your business finance YouTube playlists, and you can review that also. But what I'm concerned about at the library is I'm going to look for databases. So I click on databases. And I go to business. Look at all these databases. And I go to business. And the database that you want is called D&B Hoovers. Dun and Bradstreet Hoovers. This is a database that collects all the information about publicly traded corporations in America, of which your portfolio is made up of publicly traded corporations in America. Now, before I get to that, let me show you this little thing on the side here, Miss Linda Gordon. She is a librarian that is exclusively there to help you people, the online business finance student. If you have a question or a problem with any research or finding something, you can email her. You can call her during work hours, and she will help you with any problems you have. You also can contact me, and I will help you too. But Linda Gordon is a library reference librarian. Her sole job is to help business students with their research needs with any class. So if you, and this is something to know down the line in your further academic classes, this should be an important thing for you, is someone to help you if you need to find something. And if you click on D&B Hoovers, up comes an Access login page. So all you have to do is type in your last name and your university ID. All right, that's your ID number. Everybody should know that. It's on everything you get from us. And you type in your ID number. And you hit submit. They want to make sure you're a student here. Oops, we got a data problem tonight. Son of a gun. Great. Okay. I know they're doing some work. I was taking a gamble because I know they're doing some work on the systems this week. Couldn't get in. Okay. Well, that's not a big deal. You can go to my YouTube video that explains this process. But also, if they're running into problem and getting into that site, you can also just go to Yahoo Finance, the company's website. But these are places where all this information is stored. And I apologize, they're doing some data work tonight, so we don't have any access there. So I apologize. But that's where you can go to find this financial information. There's a lot of internet resources. If you just go to Google and just type in your company's name and just say financial ratios, it'll give you the information, trust me. So doing a little bit of internet research this week, a little bit of analysis. You are finance students, so let's do a little analysis about one of the companies in your portfolio. We're going to use this as our template to help you. And you're going to look up that information. You're going to look it up for multiple periods, 2 years. You're going to look up a variety of different information and put that into your answers of your problems to begin understanding and finding financial data for analysis. Okay. If you were a financial analyst for a company, you would need to go to the website of a company and analyze it and analyze your competitors, analyze the information. So that's something that we will be doing going forward, and we're going to talk about that after our break. So again, this worksheet, this spreadsheet is located in Blackboard. It's a modified version of our last week spreadsheet. So again, if you go to Blackboard and go to week 3, there's that spreadsheet right there. And you can use that as a template or as a helpful tool to do some of your work in assignment number 1 and going forward, okay? That's an important thing for you to have. Okay, so that completes our review of last week. Now let's get into chapter 5, the time value of money, and look at some problems. Before I do that, and we have a few minutes before we go on our break, let me bring up something here and kind of give you the time value of money in a different perspective. And we did a little bit of this last week, but let me modify it a little bit this week. Assets equal liabilities plus equity. That's the accounting equation. All right? That's the accounting equation. Assets, things that you own, equals the debts you use to acquire them, plus the equity position of your firm. And what's the equity position? Stock, profits, better known as retained earnings. The profits, those are the equity positions of your company. Okay, cool. Why do we buy assets? Because assets create products, services. The assets of a company help you create the products and services that you sell in the marketplace. To determine the value of those assets, you want to be able to determine its present and future value. If I want to purchase or build a new plant in San Dimas for my company, before I spend the money on that plant in San Dimas, I want to make sure that the money I invest in that plant is going to come back to me in the future. It's going to generate a return. It's going to generate future value. Its present value is what I'm paying for it today to build that building in San Dimas. The future value is the anticipated cash flow and profits that I'm going to receive generated by that asset into the future. Every company in the world, from University of Laverne to Amazon.com, does this analysis. Before they invest in assets and borrow money or issue stock or use profits or find a profit or find a partner on Shark Tank or find hedge fund money or whatever they do to get the capital to buy that asset, before they make that decision, they determine whether the asset is going to generate enough return. Now, a lot of that is analysis and guessing, hopefully guessing right, but before they make those decisions, that has to be done. So understanding the concept of present and future value and how to calculate it is paramount in this class. We got to do it. Okay? So when we come back from break, we're going to define present and future value in examples. How to calculate it, what does it tell us? What does it mean? The present and future value of something. Now, a lot of you may have studied this in other classes. You know, some of you are coming from the community college area. You might have studied that in community college before you came to Laverne. Some of you might have studied it in accounting. Probably not, but maybe some of you did in some accounting classes. But now this is one of the key concepts of finance, is to make sure we understand these calculations and how to do it and what they tell us. Because we're going to be working with present and future value every week for the next 7 weeks till we conclude this class. So it's important to get this down, and that's why chapter 5 is very important. So let's take a break. When we come back, we're going to take a look at those problems on pages 154 and 157 of the textbook to review these definitions of present and future value. Take a look at them. And then we'll take a look at your assignment that's going to be due next week and make sure you understand how the procedures of how we go about doing online assignments this summer. So we'll go over that as well. So I'll see you all back here about 10 minutes after the hour, about 7:10. So I'll see you all then. So take a little break, smoke them if you got them, and we'll see you in roughly 13 minutes. Thank you.